So we just heard from Bill Dudley. He's clearly concerned about recessionary signals in the US. We spoke to Mario Greco of Zurich Insurance, has good oversight globally of his world. His base case is not a recession in the US. How nervous are you about that prospect?
Not too nervous. We're more optimistic, perhaps, than most out there in the market as we think about the prospects for the U.S. economy and the risk of a U.S. recession as we look ahead. There's definitely been a tremendous amount of focus on indicators such as the SOM rule and the increase in the unemployment rate in the U.S. on a short-term basis and the overall magnitude off of the lows, as Dudley was alluding to. But there are some counterbalancing factors there that help alleviate some of the concerns that we think are reasonable to have, such as the fact that there's been such a tremendous increase in supply. So the increase in immigration in the U.S. in recent years is a big part of why that unemployment rate looks perhaps a little bit artificially high to us, so it isn't causing us great concern. Furthermore, if we look at real-time oriented data, such as where are JOLTS layoffs, they're not very high. If we look at how often are C-suite executives mentioning an intention to do layoffs going forward, also not so high.
Okay.
And CFO optimism has also been trending higher. So there are a lot of positives that are out there that I think counterbalance some of these recessionary fears.
So maybe you think the markets overdid it then at the beginning of the week when we saw all of that mayhem on Monday. What kind of landing do you think markets are priced for now? Maybe still a soft landing then, but maybe a little softer than it was, if not a recession?
We're in the soft landing camp, and I think that the yen carry trade oriented unwind that drove that extraordinary round trip in volatility Monday is a period of time that we'll kind of maybe go through for the next coming days and maybe even weeks, but is most likely to be a temporary phenomenon. I mean, if you think about the round trip that the VIX equity volatility index in the U.S. did, it basically in a 5-day period moved from about 15 to 65 on Monday and now finds itself back down closer to 30. So as some of those levered positions out there in the market are unwound, markets should focus more so on economic fundamentals, which we think look more sound than some of these panicky fears that the market has shown.
If the Fed goes 25 bips in September, is that soft landing? If the Fed goes 50, is it hard landing?
We're looking for sequential cuts of 25 basis points in September, November, December, and on a quarterly pace in 2025.
Yep.
The market has been kind of swinging back and forth in terms of how aggressively it thinks the Fed will start its interest rate cutting campaign in September. Yep. Just the other day, it was pricing in north of 50 basis points. At the moment, closer to 40 basis points. Whether they start with 50 or 25, we think that the directionality is most important here. And when a central bank indicates that they're going to start to make monetary policy more accommodative, the concept of the Fed put comes into play for markets, and that tends to be supportive from a risk standpoint, and that's a positive.
It is, but the signaling will be more. The signaling will. You're sounding quite confident, and I'm wondering what will make you rethink that confidence that the U.S. economy is heading for that soft landing. Because this is a debate at the moment. Do we get a soft landing, or is it something that we need to worry about a little bit more? Risk assets do well in the soft landing. They don't do well in the latter in a hard landing. So if we get 50, will you revisit, it doesn't sound like it, revisit your view that we're still in the soft landing camp?
We'll keep an eye on the consumer. To your question about, what might cause you to have a greater degree of concern, there's been a little bit of softening there. But overall level of corporate earnings have been coming through. We're well north of 10% in terms of this earnings season overall. We printed a 2.8% GDP number for the last quarter. We think there's good prospects for continued spending and overall economic activity. Manufacturing numbers have slowed a little bit in the U.S., but the recent services ISM number, which is even more important than manufacturing, had a notable upside surprise north of 51. So we see a good amount of positives that more so point to an economy that is slowing a bit and not full-blown decelerating enough into a recession.
It sounds like you're not going to read too much into the signal. I think Guy's talking there about what signal it'll give the markets. If the Fed is willing to go 50, is that panicky?
Not necessarily, because here's one way to think about a potential cut of 50 if we see that in September. If the Fed had that softer jobs print that we just got last week when it had its most recent meeting, they maybe would have done 25 then. So if we end up seeing 50 in September, you can sort of think of that as a 25 plus a 25 catch up a little bit. That's acknowledging the fact that they can start to ease monetary policy. As a reminder, headline inflation in the U.S. got to north of 9% not that long ago. We're all the way back down to about 3%. The inflation battle has largely been won, so there's kind of no reason at this point for the Fed not to make monetary policy more accommodative.
OK, that's really interesting. Inflation battle nearly been won. That takes me nicely on to my next question. And I want to bring in here some comments that we had from the RBA governor. Let's just have a little listen to some of the context around the recent rate decision there.
The board doesn't remain vigilant to upside risks on inflation, and it won't hesitate to raise rates if it needs to. Now, I know this is not what people want to hear, but the alternative of high inflation is worse. It hurts everyone, and I think everyone sees that.
The RBA Governor, Michelle Bullock, speaking just days, of course, after Australia's central bank kept interest rates on hold, but gave this hawkish line that they'd thought about hiking interest rates. You talk in the US context then, Erik, about how the inflation battle has been won. And I'm not sure, I don't want to complicate things by adding in the RBA and all the sort of idiosyncrasies that go with that, but I wonder if it does tell us anything about possible risks to inflation, upside risk. We were talking a lot yesterday about shipping costs and about pricing power from anything from Disney to Caterpillar. I wonder really how much confidence we do have around that inflation trajectory.
So we think that the overall pattern has been encouraging, and it's largely been a global phenomenon. But you make a relevant point in terms of shipping. We've had all the disruptions with the Houthis and the Red Sea, and the degree to which ships from a global transport capacity continue to swoop around the southern tip of Africa. If that has to continue, then that does portend pricing costs that eventually are passed on. So when people point to geopolitical concerns, they're often overstated in terms of their market impact. However, if they have a continued and more tangible impact on things such as commodity prices or shipping costs, it could become more of an issue. But for the most part, we see the global economy and the shipping industry largely managing that.
Let's get back to the markets and kind of what we've seen this week. Monday, market hits the panic button. VIX goes shooting high. You've already mentioned that. Does the VIX come back down to where it was before into an environment where it's very easy to take risk? Or do you think we're in an environment where risk is going to stay, where volatility is going to remain a little bit higher, risk is going to be harder to take, and therefore it's going to be hard to push risk assets up?
So 65 was a bit of an arguably short-term silly number, okay, I would suggest. But I would also take the other side, and you kind of look at that chart that you guys kindly just brought up. I would argue that it was at a bit of an overly complacent level for quite some period of time.
That's what I mean. So do we get if it was overly complacent before, do we go back to that? Because it was great for the CTAs to take a lot of risk on board and keep buying the market.
I think a healthier level for the VIX would more so be in the teens and low 20s and getting some of that back and forth movement in markets, which, as a refresher, is a more normal state of affairs. I mean, the rally that we've had since the October lows in the U.S. to the most recent highs was about 38% in just 9 months. Then we've had a pullback that almost hit 10% on an intraday basis on the S&P. That's actually quite normal. Markets tend to have back and forth movements. The average intra-year decline over the course of a market cycle, a market year, is about 14%. So it's more reasonable to have back and forth movements in markets, and that's perfectly okay.
In amidst all of that volatility, then, some of your clients no doubt want to hide out in some longer-term assets and longer-term investments, Erik, and you mentioned infrastructure, and a number of people do. Are you managing to find areas of infrastructure that are very nicely uncorrelated to what else is happening in markets, if that's what you're looking for?
We are. We genuinely love infrastructure-oriented strategies, partially due to their risk-adjusted return potential, what we've seen over time and what we think will occur going forward, because there's a tremendous amount of investment that needs to occur in multiple economies in infrastructure. That very low correlation that we've seen to markets overall. And we think clients are seeking those kinds of different types of investments that kind of zig when others zag. And to us, infrastructure very much so fits into that. We think that gold is another area to turn to for clients that want a degree of a diversifier in portfolios. You know, the yellow metal, so to speak, has been accumulated to a greater degree by by central banks most recently. And if you want a bit of a hedge against profligate spending by governments, rises in debt to GDP ratios, long-term debt that's a bit of a concern, we think that gold that you can also own in physical form for a small portion of portfolios is a good place to turn.